Alright, still trying to get through this part about non-traditional mortgage products and consumer protection issues. I just explained at the top of page 29 of my reference guide to regulatory compliance manual in the credit section 2, chapter on advisories on predatory and subprime lending. So now there's legal risks. To the TILA, the FTC, RESPA, and states sometimes have deceptive trade practices. Recommended practices reducing risks include communications with consumers, promotional materials, payment shock, negative amortization, prepayment penalties, cost of reduced documentation loans, monthly statements on payment option loans, practices to avoid, and control systems. To go into each of those in an outline format, the following are recommended practices for reducing the risk of non-traditional mortgages. 1. Communications with the customer. Offer clear and informative communication. Give the communication to consumers at the appropriate time. Information should be given at the time information is requested, not just at the time of application. Promotional materials should provide information about cost, terms, features, and risks of the products. Payment shock. Communications with consumers should apprise them of the potential for payment increases, including circumstances in which negative amortization or interest rates reach a contractual limit. Examples should be used in product descriptions. Negative amortization. When negative amortization is possible, consumers should be given notice of the potential for increased principal and decreased equity in the property. Prepayment penalties. If a prepayment penalty is charged, the consumer should be informed of this fact and alerted to the need to ask about the amount of the penalty. Cost of reduced documentation loans. If the institution offers both full and reduced documentation loans, and there is a pricing premium attached to the reduced documentation loan, the consumer should be alerted to this fact. Monthly statements on payment option loans should provide consumers with a clear statement of the options available. Each option should include a statement of the impact of that choice on the loan balance, and each option should include a statement of it. Institutions should not lead consumers with payment option arms to choose a non-amortizing or negatively amortizing method. Practices to avoid. Avoid practices that obscure risks to the consumer. Do not give unwarranted assurance to the consumer. 9. Control systems. Institutions should develop control systems to determine that actual practices are consistent with policies and procedures. Controls should address safety and soundness and consumer protection issues. Lending personnel should be able to communicate information about the institution's products to consumers in a timely and balanced manner. Lending personnel should receive periodic training on non-traditional mortgage products and risks. Lending practices should be monitored for compliance. Legal reviews should be appropriate. Lending compensation should be reviewed for appropriateness. Risk of using third parties and brokers should be mitigated. Now there's a statement on subprime mortgage lending. Before I just move right on, let me think on this thing that we're calling payment option arms. In fact, rather than thinking on it, I know that we have the ability to do arms at my bank, and so I'm going to write down here that the guidance on non-traditional mortgage product risk is the regulation. I don't know who issues it yet, probably the OCC, but I don't want to be overly presumptive. So the guidance on non-traditional mortgage product risks. The statement will go on page 29. And it's regarding payment option loans. Now, the criteria is that payment option impact should be transparent, and the bank should not lead the consumer's decision. Statement on subprime mortgage lending is here on page 30. The coverage section, purpose section, risk management practices section, workout arrangement section, consumer protection principles section, control systems, and supervisory review sections follow. So in coverage, the agencies issue the guidance because of concerns about adjustable rate mortgage loans that have one or more of the following characteristics: low initial payments based on an introductory rate that expires after a short period and then adjusts to a variable index rate plus a margin for the rest of the loan term. 2, of very high or no limits on how much the payment amount or the interest rate may increase. 3, limited or no documentation of the borrower's income. 4, product features likely to result in frequent refinancing to maintain an affordable monthly payment. And 5, substantial prepayment penalties or penalties that extend beyond the initial fixed interest rate period. Purpose of the statement on subprime mortgage lending: to address emerging issues and questions related to subprime mortgage lending practices, and to encourage the provision of information to borrowers regarding the product features and risks. The risk management practices section, predatory lending considerations. Subprime lending is not considered predatory lending. Predatory lending involves at least one of the following: making loans based predominantly on the foreclosure or liquidation value of the borrower's collateral rather than on the borrower's ability to repay the mortgage, inducing a borrower to repeatedly refinance a loan in order to change high points and fees each time the loan is refinanced or flipped, engaging in fraud or deception to conceal the true nature of the mortgage loan obligation or ancillary products from an unsuspecting or unsophisticated borrower. Institutions that offer predatory mortgage loans have an elevated risk that they will commit an unfair or deceptive act or practice in violation of the FTC Act. Underwriting standards. Each federal banking regulatory agency has issued real estate guidelines which provide underwriting guidelines. Guidelines should evaluate the borrower's ability to withstand payment shock and repay the mortgage at its fully indexed rate. The borrower's debt-to-income ratio should include the borrower's total monthly housing-related payments as a percentage of gross monthly income. Institutions should have a clear policy governing the use of risk layering features such as reduced documentation loans or simultaneous second lien mortgages. Mitigating factors should be present when risk layering features are combined in order to support the underwriting decision and the borrower's repayment capacity. Institutions should verify and document the borrower's income and assets and liabilities. Stated income and reduced documentation loans to subprime borrowers should be made only if there are clear documented mitigating factors. Workout arrangements. Workout arrangements are encouraged. Prudent underwriting practices should guide workout arrangements. Regulatory agencies should not criticize reasonable workout arrangements. Institutions should identify and report credit risk, maintain an adequate allowance for loan loss, and recognize credit losses in a timely manner. Consumer protection principles. Institutions should approve loans based on the borrower's ability to repay. Institutions should provide consumers with information that enables the consumer to understand the material terms, costs, and conditions of the credit. All customer communications, including advertisements and disclosures, should provide clear and balanced information about the risks and benefits of the mortgage products. Information should be provided at the product selection phase, not just when submitting an application or closing a loan. Consumer information should include risk of payment shock, potential payment increases, how the new payment will be calculated when the introductory rate expires, ramifications of prepayment penalties, how they will be calculated, when they will be imposed, and ramifications of balloon payments. Moving along, ramifications of the lack of escrowing for taxes and insurance, who is responsible for paying taxes and insurance, and the fact that their costs may be substantial, and cost of reduced documentation loans, whether there is a pricing premium required. Applicability of prepayment penalties should not exceed the initial reset period. Borrowers should have a reasonable period of time to refinance without penalty. Control systems. Controls should determine whether practices are in compliance with policies and procedures. Control systems should address compliance, consumer information concerns, safety, and soundness. Controls should include institutions, personnel, and applicable third parties. Important controls include establishing criteria for hiring and training personnel, entering into and maintaining relationships with third parties, conducting initial and ongoing due diligence on third parties, compensation programs that avoid inappropriate incentives. Policies and procedures should be in place to monitor compliance with laws, regulations, third-party agreements, and internal policies. Consumer complaint review procedures should be in place. Supervisory review. Regulatory agencies will continue to focus on risk management, review, and consumer compliance processes. Agencies will continue to take action against institutions that violate consumer protection laws or fair lending laws and that engage in unfair or deceptive acts or practices or in unsafe or unsound lending practices. Now I've come upon the question section. Alternative mortgage transaction parity, is the next section on page 35. The OCC first issued the adjustable rate mortgage regulations in 1981 because of the increased number of ARM loans made by national banks. The regulation was revised in 1983 to provide for greater flexibility in ARM lending. The revised regulation required disclosures in all ARM transactions for both state chartered and national banks making ARM loans under the Mortgage Transaction Parity Act of 1982. In addition to the OCC, the FHLB had an ARM regulation. In the mid-1980s, a movement began among the federal supervisory agencies to provide a uniform ARM regulation. In 1988, the Fed added the uniform ARM disclosure requirements to Reg Z, TIL. Therefore, most of the original OCC ARM consumer protection requirements are now found in Reg Z. ARM loans made by national banks may be subject to the OCC's ARM regulation or the requirements of Reg Z or both. The DFA amended the Mortgage Transaction Parity Act to balance access to housing credit between state and federally chartered lenders. The CFPB issues Reg D in 2011 to implement the provisions of the amended statute. I'm going to read about the OCC ARM rule in just a